2025 is finally over, and it was kind of a crazy year for investing, with markets reaching new all-time highs that we've never really seen before in many ways, the AI bubble accelerating faster and faster and faster, and Trump's tariff war that started in the beginning of this year, which caused the markets to crash. Really, a lot has been going on. But what can we expect for 2026? Well, today, I will do my predictions and I will share my strategy for 2026. So, let's get into it. Now, let's start by looking at my 2025 predictions. First of all, I expected that markets would come down, which did actually happen, but they continued to rally afterwards. Secondly, I expected crypto would peak, which kind of happened as well, but I'm not sure if this is truly the final peak. The third thing I said was that the Fed would become more dovish, which is the Central Bank of America, and becoming more dovish means that they become more relaxed and are stimulating the economy, so they're not increasing borrowing costs and they're actually pumping money into the economy, which actually happened. They lowered interest rates massively. They stopped quantitative tightening, which is basically taking money out of the system. And now at the beginning of this year, they will actually start pumping money into the system, adding $40 billion of liquidity every month in the system to facilitate loans and anything else. And I said that most of Trump's plans wouldn't happen or would backfire, which also happened because Trump, as we all know, chickened out a lot this year. Oh, we're gonna throw these tariffs on you. 3 weeks later, never mind. And now even the tariffs might not even happen because the Supreme Court said that it's not allowed. So it will be interesting to see how that turns out in the end. It's gonna be an interesting year when it comes to that, at least. So my 2025 predictions were actually pretty great. And my overall strategy didn't work out perfectly. While we were able to sell some assets that I intended to sell, well, like silver, like PAST, like TSMC, as mentioned here, I wasn't able to flip cryptocurrency at the highs that I wanted because the euphoric cryptocurrency like market cycle didn't really happen. But that all makes sense if you look at the grand picture, but I will get back to that in a second. However, overall, this year was not too bad. Sadly enough, we weren't able to profit off of everything as much as I thought we would. We ended up getting around an 8% profit, which is underperforming the S&P 500, sadly enough. Again, because I expected cryptocurrency to do a whole lot better, but it just didn't. I'm completely fine with holding these assets for the long haul. So, yeah, it didn't really pan out completely as I wanted. But in the end, we still made a profit and we're holding great assets. So I'm completely fine with it. We're here for the long haul after all. But let's look at 2026 real quick. What is my strategy and what do I predict for that year? Now, in the past, I have said that the American stock market is overvalued. And in many ways, it still is. If you look at the Shiller PE ratio, you can see that it's at almost the highest point ever. And even if you look at something like the Buffett indicator, which compares the total stock market value to the total value of the economy, you can see that it's incredibly overvalued. Now, you do have to keep in mind that the Federal Reserve also has some cash holdings in the market, directly basically, with their total assets balance sheet. So you got to deduct that from this. But even if you do that, for example, by using Guru Focus, their Buffett indicator, because they actually added this to the calculation, which is great, even then you can still see that we're at 182%. Which is far from normal. Far from normal. Even during 2000, the bubble wasn't this big. But now we're at 182% with Federal Reserve, so central bank money and investments in the economy to stimulate it included. And without their money, we're at 221%, which is just a crazy number. As you can clearly see on this website as well. In general, the market is overvalued, but surprisingly enough, I actually expect this bubble to continue to inflate. Because when you look at the price earnings growth ratio, it's not even that high. With the updated graph, this goes to around 1.3 or 1.2 if I remember correctly. But we're nowhere near as high as you would think. But still, you got to remember that doesn't matter as much. In before the 2000 bubble popped, we were also at like 1.5, 1.6 maybe. So we can still come down from here, don't get me wrong. But there is clearly room for growth in the price earnings growth ratio. And the second thing that has changed is that there is support from the central bank and the government. If we look at the federal funds rate, which is the interest that you pay on your loans, we can see that this has been lowered a lot by the Federal Reserve. First, it went up massively, constricting the economy. But surprisingly enough, it didn't constrict it as much as many would think, because many companies took out incredibly cheap loans when interest rates were very low during COVID. And during this time, 2022, 2023, 2024, 2025, a lot of big tech companies were investing heavily into AI and anything related to it. From memory to copper to solar panels or nuclear, whatever they needed to make the AI dream happen, real estate, whatever they needed, water, they spent on it, which has kept this economy going for the most part. And they were able to do this because a lot of big tech companies had massive cash reserves. From 2010 to around 2020, 2021, big tech companies like Google, like Amazon, like Netflix, Amazon, they didn't really have much to spend on. Sure, they spend on robots, they spend on automation, they spend on warehouses, they spend on new servers, but it was nothing compared to how much they were making. So for a lot of big tech companies, you saw their cash buffers rise and rise and rise and rise. We have $100 billion in cash, $200 billion in cash, $500 billion in cash. They just kept collecting more cash. And now that AI is here, something they can finally spend on, which looks promising to them, they are throwing all of that money back into the economy. So while the central bank was making borrowing more expensive, as well as directly taking money out of the system, around $2.4 trillion out of the system, it didn't matter as much. Because it was all balanced by the big tech companies throwing all their reserves into the economy. And maybe a little bit of debt so far, not much debt. However, now they're still putting a lot of their free cash and any savings account cash they have into AI. And now that the Federal Reserve has lowered interest rates and is going to pump money into the economy again to support liquidity, so similar to what they did here, or similar to what they did during COVID, like here. Now these big tech companies can use that new cash coming in and those cheaper loans, as well as any of the incoming cash from operations and any savings left, to continue to fuel this AI bubble, which is exactly why I think the bubble isn't over yet and we're actually going to see a form of a melt up phase. Even the 2000 tech bubble, a lot of people thought that in 1997 it was done. But at the end of the day, it continued to around 2000, 2001, which is kind of crazy. And I expect a similar thing here. I don't know if it's going to take 1 year, or it might even last 3 or 4 years. But we're going to see these companies take on debt and use their cash flows to continue to pump this bubble. Meanwhile, the central bank, which is the most insane part about this, the central bank is actually helping them by lowering interest rates and pumping cash into the market again. Even though the market is arguably in a bubble. Because while price earnings growth is a great ratio in many ways, if the growth is not as good as expected, we can head much lower very quickly. We can still go into a recession, it doesn't matter. Growth is based on expectation, and those expectations can be over-enthusiastic or overly depressing. So when it comes to growth valuations or expectations from economists, always take them with a grain of salt, because they can flip from one moment to the other. I mean, you can see this in this chart even. You can see it spikes all the way up and then it crashes, and then spikes all the way up and then it crashes. Or even here, mini crash. Didn't matter. Just the market just continues, or spike here in 2016 and then it went all the way down. Didn't matter. 16 to 2019, the S&P 500 just continued to climb. You take this with a grain of salt, but this clearly shows that over the long run, this is not sustainable. A Buffett indicator of 300, 400, 500% is never going to happen. It's never going to happen. I do not expect it. Or we're going to have the biggest bubble that has ever happened in history. or at least 100 years, like a world-ending, world-changing bubble, like the Great Depression was, which led to World War II and a complete reshuffling of the world order. But yeah, the crazy thing is even though we're in a bubble and we're expecting a lot from this AI growth and a lot of even the growth to accelerate even more, the central bank and even the government itself is fueling it. We've all seen in the past how Trump has come around the corner with Project Stargate, if I remember correctly, and other AI programs to make America the AI world and blah, blah, blah. And we all know that Trump loves to stimulate, and he said multiple times that he wants interest rates to go down much lower, and he's actually going to pick a new head of the central bank who might be on his side and actually push to lower rates even more than they already have, even though the economy is booming in some ways and not in others. I mean, unemployment has increased quite a lot, and they're pumping money into the economy. But even Trump's administration is helping by adding around $4.5 trillion of new debt spending with the big beautiful bill in tax cuts and all kinds of other incentives directed towards consumers, but also big companies or AI companies or whatever. And they're taking stakes into other companies. So even the central government itself, like the federal government, is stimulating like crazy. The central bank is stimulating like crazy. We're already in a bubble. I actually expect, weirdly enough, a form of a melt-up phase. So at this point, I would not bet against the market. I would never advise it, but now especially I wouldn't. In a bubble like this, things can become very irrational. But what is my strategy now that I expect this bull run to continue? Now, when it comes to my plan, my strategy for the portfolio, it is actually rather simple. At the moment, the main three sectors that we're in is technology, healthcare, and cryptocurrencies. The technology and healthcare stocks will most likely be in the portfolio for the long haul, because many of them are great companies that I would love to hold for the long run, and it will probably take time for value to go back into the stock itself. For example, Novo Nordisk, United Health, both great companies, and even something like ASML and Genpact and Qualcomm, also fantastic companies and relatively cheap still at the moment, except ASML. I want to keep some exposure to those tech companies because of AI, and unless they go completely parabolic and the valuations become completely unreasonable, I will most likely hold them. Same goes for the healthcare companies. However, I hope to see a continuation of the crypto cycle, because now that the central bank and the government are both stimulating the economy and we're out of that restrictive zone, this zone where just money got taken away, and interest rates were just increased for the most part, I expect crypto to finally finish that rally, because so far it has been kind of disappointing. A lot of projects, like a lot of coins aside from Bitcoin, really went nowhere or didn't make a new all-time high, even though a lot of them grew 5, 10, 20x when it comes to users, revenues, fees, daily volume. I discussed this in older videos. I actually added Lido DAO because the coin is so undervalued. If they would literally liquidate the entire project right now and just give all the cash to any Lido holders, you would literally get like 20 to 30 cents per Lido token, and they're growing at 30% a year, and they have basically a dividend payout. If they would pay out all their income in terms of a dividend to Lido holders, they could literally pay a 15% dividend, which is nuts. Lido DAO is like valued at like half of $500 million, while there's $30 billion in the ecosystem, and they make like 80 million a year in profit. It's I don't know how it's so undervalued. So I actually invested more into crypto, and I expect this crypto cycle to finish, because there's still a lot of growth and momentum in crypto with new adoption, new value coming in for terms of stable coins and other stuff. And that was under a very restrictive Federal Reserve, a Federal Reserve that tried to slow down the economy, slow down asset prices, slow down housing prices, slow down that economy. No growth, gotta kill that inflation. And still crypto was able to grow relatively well. I expect the crypto bull market to finish this year, maybe into next year as well, due to all this new money coming in and all this stimulus. So the majority of this portfolio will remain in place. ASML, Genpact, Qualcomm, NVR, which is actually real estate, Nextpower, which is solar, SCHD, which is like classic dividend. All that stuff will most likely stay in place. Adobe, Baba, unless valuations go crazy. But I hope to see the finishing of the crypto cycle, and I expect that to happen. As soon as we're able to sell those crypto holdings, I would love to fuel that money within a relatively short time frame back into equities if the market crashes. It would be perfect if the market would crash. If I would sell the crypto and 3 months later the AI bubble pops and the S&P 500 goes down by 40 to 50%. Because then I'll most likely put my money in what's called leveraged ETFs, giving me leveraged exposure to S&P 500 and the NASDAQ, those collections of companies, those safe baskets with very relatively low risk and relatively low cost. So that's kind of the plan. This was my plan for last year as well, but I think that the plan remains the same for the most part. It's just the time frame gets shifted. If we're able to pull off that perfect flip, then we'll make a lot of money. But for now, it is just a waiting game. I will continue to hold some of my portfolio in cash, as well as have some hedges in place like TMF, which will do incredibly well if the central bank lowers interest rates, which they will most likely continue to do. And in the meantime, it's paying out a rather great dividend. So yeah, that's kind of the plan. Overall, 2025 was interesting, and I think 2026 is going to be even more interesting. But let me know in the comments down below what you think will happen. And be sure to check out my eToro, because I post a lot on eToro in terms of small little articles, researching stuff or explaining stuff about stocks or crypto. So be sure to check it out. And you can also find the whole full transcript and with more details, explanations, as well as sources on my eToro about the stuff that I covered in this video. Yeah, I hope you all enjoyed this video, and may the markets be with you in 2026.